If you're an incorporated business owner in Canada, at some point you've probably asked yourself, am I actually structuring my wealth properly for the long term? Because early on, it's all about growth. How do I reinvest? How do I reduce tax today? How do I build retained earnings? But eventually that question changes. And that's usually when things like individual pension plans, otherwise known as IPPs, and personal pension plans, PPPs, start to come into the conversation. And they're often positioned as the next level strategy, a better version of the RRSP, a way to create bigger deductions, and more. But the reality is, there's a lot more nuance to it than that, because these aren't just better RRSPs, they're actually a different way of structuring how your wealth flows through your corporation. And like most things in corporate wealth planning, they only make sense when the timing is right, the structure is right, the intent is clear. And in this video, I want to walk you through what an IPP actually is, what a PPP actually is, and who they're really for, and finally, when they actually make sense for you, the business owner, to consider. Let's start simple. An individual pension plan, or an IPP, is a defined benefit pension plan set up by your corporation. Now that sounds technical, so let's simplify it. With an RRSP, you decide how much to contribute. With an IPP, you decide what retirement income you actually want. And then an actuary works backwards to figure out how much your corporation needs to contribute each year. Instead of asking, how much can I put in, you're actually asking, what am I trying to create in retirement? Those contributions are made by your corporation, they're tax deductible to the corporation, and invested inside a pension structure. So what you get is structure and predictability, but you do end up giving up some flexibility. Now, a personal pension plan, or a PPP, builds on that idea. It still includes that defined benefit structure, but adds more flexibility. Things like defined contribution components, additional voluntary contributions, more control over how contributions happen from year to year. So in simple terms, a PPP gives you more levers to pull, which can be really valuable. But it also adds more complexity, more coordination, and a little bit more in terms of maintenance fees from year to year. Now, at a high level, all of these, the RRSP, the IPP, the PPP, they're all trying to do the same thing, move money into a tax-deferred environment for your future. The difference is where the money comes from, how contributions are calculated, and how flexible the system is over time. Now, these plans are not for everyone. They tend to work best for business owners who are incorporated, they've been paying themselves consistent T4 income, they're typically in their mid-40s or beyond, and they're planning to work for at least another 10 or more years. But here's the key. Just because you can set one up doesn't mean you should. This is where most people get it all wrong. They think once I'm successful, I should get an IPP or a PPP. But in reality, these strategies are usually more effective later, not earlier. In your 30s and in your early 40s, flexibility likely matters more. You're probably still building your business, and you're deploying capital in different ways. That's where RRSPs or corporate investing and insurance strategies can often do most of the heavy lifting. But as you move into your late 40s and into your 50s, things start to shift. Income hopefully is stabilizing, contribution room is increasing, planning becomes more important than actual growth. That's when these plans start to make the most sense. Another big factor is your corporate tax rate. If you're earning under $500,000 of net operating income, you will likely be in a lower corporate tax rate, which means flexibility-based strategies often win. But once you move beyond that, the value of deductions increases significantly, and that's where pension strategies can start to make more and more sense and really become more and more attractive. But before even thinking about an individual pension plan or a personal pension plan, these are a few of the things that should already be in place. First and foremost, a consistent salary strategy. understanding how RRSPs fit, a clear, concise corporate investment plan, and a broader wealth management system, often including insurance strategies. Because adding more complexity doesn't fix a broken foundation. Now, let's talk about the real difference, because this is where most people get stuck. An IPP works really well if your income is stable, your structure is simple, and you value predictability. It's typically lower cost to set up, somewhere between $1,500 and $1,800 per year, but it is more rigid and it is a little easier to manage. Now, the personal pension plan becomes more interesting when income fluctuates. You want more flexibility, and maybe you even have multiple family members that are involved in your business. It's typically a little higher cost, somewhere in the $2,300 to $2,800 per member per year, but it is more flexible and it does have more complexity. Now, the biggest difference is this: flexibility inside the plan. Both have a defined benefit component, but a PPP adds a defined contribution layer, which means in strong investment years where the IPP might force you to stop contributing, a PPP allows you to turn down the DB portion or the defined benefit portion and keep contributing through the DC or the defined contribution portion. That means you keep deploying capital, you keep momentum, and even potentially use RRSP style contribution room inside the structure. That's a big deal, and it's a big win, specifically for those people who have a large net operating income per year inside their corporate structure. Now, one thing people often misunderstand: these pension plans do not eliminate tax. They defer it. Just like your corporate structure is deferring tax on the dollars that you're not taking out to a personal level, these pension plans are doing something very similar. So when you start drawing income, it is going to be taxed just like an RRSP, an RRIF, a LIF, or any of these other registered retirement strategies that we've been using in the past. But you're going to gain control over when the income shows up, how it's split between spouses, how it integrates with other income sources. Now, when we talk about legacy and succession, this is a really interesting feature that even on its own may outdo the RRSP strategy. Now, in certain situations, especially in a family business, if children are involved and part of the plan, that means that they're actual employees of the company and they become a part of your IPP or your PPP, the pension structure can continue even after the parents move on, which means that you get continued tax deferral across generations. So instead of triggering a large tax bill at death like an RRSP or an RRIF or any of these other registered retirement plans, you get to defer those taxes and the next generation gets to enjoy them via their PPP or IPP. So when you step back, this isn't about which one is better. It's about which one fits my stage, my structure, and my future. Because the best strategy isn't the most complex. It's the one that fits. Now, if this helped you to think about your situation a little bit differently, I'd be curious to hear, where do you feel you are right now? Are you still building? Are you starting to stabilize? Or are you optimizing for the long term? Drop it in the comments, or if you'd like to explore on how this actually applies to your situation, feel free to reach out to us over at CanadianWealthSecrets.com. And if you'd like to book a call, reach out at CanadianWealthSecrets.com/discovery for a free discovery call. We look forward to working with you and helping you reach your financial freedom sooner.